Hi everyone, so let's now take a look at the Bank of England, its Monetary Policy Committee and the CPI inflation target of 2% over the medium term. Okay, so remember the CPI refers to the Consumer Price Index and of course is the main inflation target that is used within the UK economy. Now, the Monetary Policy Committee determines monetary policy for the UK through interest and exchange rates and the money supply. Now, that Monetary Policy Committee is a group of members of the Bank of England who meet each month to discuss the economy and inflation targeting at that 2% level. Now, it's deliberately quite ambiguous, this inflation target of 2% over the medium term. What is the medium term, for instance? It's very difficult to distinguish this, and certainly the Bank of England is much criticised for its failure to actually achieve this over any period, let alone the medium term. Okay, nevertheless, they do have a role to play in the economy, and they have or are said to have autonomy. That is, they are meant to be independent from the government as of 1997. Okay, so let's take a look at some of the potential advantages of having an inflation target and our Bank of England really focusing on inflation. Okay, so firstly, it can help to control inflationary expectations. So by helping to control inflationary expectations, that actually links with my last point about promoting confidence. It means that consumers' real wages will be sustained or will be maintained at that given level, and therefore their purchasing power will remain relatively strong. It will also mean that businesses don't face rising costs as a result of cost push pressures. Okay, so there's a number of points which relate to each other within that expectations. If you have positive expectations, then that's likely to reinforce to better confidence in the economy overall. Okay, so the Bank of England can also attempt to influence aggregate demand and demand pull pressures within the economy. So, for instance, as we approach a boom and rapid economic growth, or a period of sustained economic growth, which is above trend and there's a positive output gap, the Bank of England will really be tightening its monetary policy. They'll be increasing interest rates, and that will help to curb those demand pull pressures in our economy. Okay, we've also got this point about influencing cost push pressures, although this is very much debatable. To what extent can the Bank of England actually influence cost push pressures in the economy? Well, certainly if they keep inflation relatively low, it may help to reduce wage demands from employees where they pursue higher and higher wages, because their purchasing power is maintained in real terms. Okay, so that's an interesting one, but we live, of course, in such a globalised world where oil prices will have a direct impact on inflation. To what extent can the Monetary Policy Committee actually influence this? Well, they're likely to try to do this through the exchange rate, and interest rates have a direct impact on the exchange rate because it influences money or capital flows, hot money flows, as money transfers to areas with higher interest rates. Okay, and then lastly, we've got that point about promoting confidence, and that's consumer and business confidence. So confidence in the economy is likely to improve if inflation is stable. Okay, in addition to some of the policy tools you're going to be very familiar with anyway, so interest rates and quantitative easing, the Bank of England may use alternative approaches as well, such as forward guidance. Forward guidance is really where you see the Governor of the Bank of England, Mark Carney, or his deputy appearing in press conferences and actually giving their expectations about the health of the economy and where interest rates and inflation are likely to go in the coming months. Okay, so again, that's about reassuring the markets and reassuring businesses and consumers. In addition to that, they could also use reserve requirement ratios. So you may come across that depending upon your reading. Reserve requirement ratios affect commercial lenders, so that is domestic banks. Now, when you think about those banking institutions, if they make a £100 loan, there may be a reserve requirement ratio which says they need to keep £10 or 10% of any loan that they make. Well, that reserve requirement could be increased to perhaps 20%, where they need to retain £20 for every £100 of lending that's actually conducted in the real economy. And of course that can help to restrict the amount of lending that takes place, and therefore the increase in the money supply that could occur as a result of that. Okay, so of course there's some disadvantages though, and those disadvantages include, of course, the fact that there's factors outside of the control of the Monetary Policy Committee because of global demand, and these demand pull pressures could actually be generated by the likes of rapid growth in India and China and the large markets that exist there. Yeah, how is the Bank of England going to control that? Well, it's not really going to have much of a role to play there. Then we've got oil prices, okay, and commodity prices more generally. So again, it's difficult for the Bank of England to influence this apart from increasing the interest rate and making our currency stronger. So then we have strong pound, imports cheap, exports dear, so that would limit the demand for our exports, okay? But of course that would conflict with our macroeconomic objective of attaining a current account surplus perhaps, or simply reducing our deficit. Moving on, does setting a target actually serve any sort of purpose? Certainly, when it's not achieved, to what extent does it actually fulfill any purpose? Yeah, so that's our final point there, that the Bank of England has been much criticised for its failure to achieve this over any period, let alone the medium term. Okay, so let's have a look at some evaluative points you could consider in any essay on inflation targeting. Yes, it's going to conflict with macroeconomic objectives, as we've just said, regarding that point about the balance payments at the current account. Okay, so is core inflation a more realistic target? That is where you strip out the sort of volatile prices that you may see, those volatile price changes in markets for commodities. Okay. So to what extent can the Monetary Policy Committee actually predict the future, and so therefore how good are they actually in determining what's going to be best for the economy? And then what about the purpose of the target? Surely low stable inflation is more important, or you could alternatively argue that actually they should be reinforcing the government's macroeconomic objective of sustainable economic growth, perhaps. Why is inflation seen as so important here, when if it's low and stable, then that's got to be the important thing? Okay, and finally, how credible is the Monetary Policy Committee? And of course, this is influenced partly by this. Okay, so it is much criticised. Yeah, all right. I hope that's all right, guys. Thanks a lot.